It is a fear many Americans share. The sudden, firm knock on the front door. On the other side, an agent from the Internal Revenue Service, the IRS. They are here about your unpaid taxes. They are here to take your home. This is a powerful and terrifying image, one that fuels countless stories and causes sleepless nights for families across the country. But how much of this scenario is fact, and how much is fiction? The reality is far more complex than the myth. The IRS does have immense power, but that power is governed by strict rules, procedures, and timelines that you need to understand. The truth is, yes, the IRS can, in some circumstances, seize and sell a person's home to satisfy a tax debt. It is the ultimate collection tool in their arsenal. However, this is not a common event. It is a last resort, used only after a long series of notices, warnings, and missed opportunities to resolve the debt. Most people who owe taxes will never face the seizure of their primary residence. The IRS is fundamentally a collection agency for the U.S. government. Its main goal is to collect the money it is owed, not to make people homeless. Understanding this distinction is the first step toward taking control of the situation. This essay will walk you through the facts. We will break down exactly what the IRS can and cannot do when it comes to your home. We will define the key terms you will encounter, like lien and levy, in simple language. We will outline the step-by-step process the IRS must follow before it can even consider selling your property. Most importantly, we will show you the specific actions you can take to prevent that from ever happening. The goal is to replace fear with knowledge, giving you a clear path forward if you find yourself facing a tax debt. Knowledge is your best defense against the anxiety that comes with owing the government money. We will cover the notices you must watch for and the deadlines you cannot miss. We will detail the various payment options and relief programs available, from simple installment plans to an offer in compromise. We will also explain when it is critical to seek professional help from a tax attorney or an enrolled agent. By the end, you will have a practical, actionable guide to navigating this stressful situation and protecting your most important asset, your home. You have rights, and you have options. To protect yourself, you first need to understand the language the IRS uses. 3 words are central to this entire process: lien, levy, and seizure. Lien, levy, seizure. They are often used interchangeably, but they mean very different things. A lien is the foundation of the IRS's collection power. A notice of federal tax lien is a legal claim against your property. Think of it as the government publicly calling dibs on your assets, including your house, to secure its interest in a tax debt. It does not mean the IRS is taking your home tomorrow. A lien is a public notice to other creditors that the government gets paid first if you sell the property. That makes it very difficult to sell your home or refinance your mortgage, and it can block you from getting other loans until the lien is cleared. It is a powerful warning shot, but it is not the final blow. Next is a levy. A levy is the actual act of taking property to satisfy a tax debt. While a lien secures the government's interest, a levy is the IRS actively collecting on that interest. A federal tax lien is a serious matter, but it's crucial to understand that it does not appear out of thin air. It's the government's legal claim against your property to secure payment of your tax debt, but it's not the same as seizing your assets. That's a different step called a levy. The IRS must follow a specific, multi-step legal process before it can file a lien against your property. This procedure is designed to give you fair warning and multiple opportunities to resolve your tax issue. It all begins after the IRS assesses your tax liability, which is the formal process of recording that you owe taxes. Next, they must send you a bill, typically a letter known as a notice and demand for payment, like a CP-14 notice. This letter will detail how much you owe, for which tax period, and demand that you pay it. The final condition is that you neglect or refuse to pay the full amount within the time frame specified on the notice. This initial notice is your first official warning that a debt exists and that the clock has started ticking. It's your primary window to act before the situation escalates. Ignoring this first piece of mail, perhaps out of fear or uncertainty, is often the first critical mistake people make. It's a mistake that closes doors to simpler solutions and can lead to much bigger problems down the road. If you do not respond to the demand for payment by paying or making other arrangements, the IRS can then file a Notice of Federal Tax Lien. This legal document is filed with local county records offices, making your tax debt a public record. This means anyone who runs a credit check or a title search on your property will see it. This public filing is what officially establishes the government's claim, putting the world on notice. It alerts banks, future lenders, and potential buyers that the IRS has a priority right to your property over most other creditors. Critically, the lien attaches to all your assets, your house, your car, your financial accounts, and it even covers property you acquire while the lien is in effect. Because it becomes part of your credit history, your credit score will almost certainly be damaged, making it difficult and more expensive to get a loan for a car, a mortgage, or even a new credit card. Getting a loan for a car or a mortgage for a new home becomes nearly impossible. If you try to sell your current home, the lien must be paid off from the proceeds of the sale before you receive any money. In essence, a lien freezes your financial life, making it very difficult to move forward until the tax debt is resolved. It is a powerful tool designed to get your attention and compel you to address the outstanding tax bill. It is important to remember that a lien is a claim, not a seizure. The IRS is not showing up with a moving truck at this stage. You continue to live in your home and own your property. However, the lien gives the IRS a secured interest, which means they have a powerful legal position. The lien will generally remain in place for 10 years or until the debt is paid in full. Releasing the lien requires paying the debt, but you can also apply for other resolutions, like a discharge of property or a subordination of the lien, which might allow you to refinance or sell under certain conditions. If a tax lien is a warning shot, a levy is the IRS taking direct aim. A levy is the forcible collection of taxes. It only happens after the lien process has begun and you have continued to ignore demands for payment. The IRS can levy financial assets, bank accounts, retirement accounts. It can also levy physical assets, your car, your boat, your real estate. This is a significant escalation. Before the IRS can levy property, it must send a series of notices. The most critical is the final notice of intent to levy and notice of your right to a hearing. The IRS generally cannot levy your principal residence without a federal district court judge's approval. That judicial review is a significant hurdle. But those protections don't apply to second homes, vacation properties, rental houses. The IRS can seize and sell those more easily. Even when cleared, home seizure is usually a last resort. The process is administratively burdensome, expensive, and generates negative publicity. The IRS manual tells agents to consider other options first. They'll compare the total tax owed to the home's equity. If the debt is relatively small, a sale is unlikely. They're far more likely to levy your wages or your bank accounts first. Home seizure is typically reserved for large tax debts, years of non-compliance, and a refusal to cooperate. Navigating an IRS collection issue is, all about understanding the timeline. The process is not random. It follows a predictable sequence, each with its own deadline. Missing a deadline can cost you important rights, so check your mailbox. First letter, CP14. It's a bill. It demands payment. Initial chance, pay the bill or contact the IRS to dispute it. If ignored, next, CP504. Notice of Federal Tax Lien. It warns a public lien may be filed against your property. Your credit can be affected. It explains your right to appeal. You have a limited time to request a hearing. Most urgent, final notice of intent to levy, often labeled Letter 1058 or LT11, final warning before property can be taken. It arrives via certified mail. You get 30 days to pay the debt, set up a payment arrangement, request a collection due process hearing. Requesting CDP within 30 days stops the levy process. Miss the deadline and the IRS can seize your bank accounts and garnish your wages without further notice. If no action after 30 days, the IRS can move forward with seizure. For a personal residence, this is not the end yet. The IRS must issue a notice of seizure and give you a copy. Then they must issue a notice of sale at least 10 days before sale. That notice is delivered personally and published in a local newspaper. From first bill to final notice of sale, you can still intervene and resolve the debt. The key: never ignore an IRS notice. The moment you receive a notice from the IRS, you have options. You are not powerless. The tax code provides several avenues for taxpayers to resolve their debts and prevent collection actions like a lien or levy. These options are your shield. They can stop the immediate threat. They are also your sword, allowing you to proactively address the underlying problem. The most important thing is to choose an option and communicate your intentions to the IRS. Silence and inaction are what lead to the worst outcomes. The IRS is far more willing to work with taxpayers who are actively trying to find a solution. The simplest solution is to pay the tax debt in full. If you have the funds available, this will stop all collection activity immediately. Once the debt is paid, you can request that the IRS release the tax lien, which will clear your public record and help repair your credit over time. For most people, however, paying a large tax bill all at once is not possible. That is where other options come into play. When facing a tax bill you can't pay all at once, the IRS offers several resolution paths. The most common is an installment agreement. This is a formal payment plan that allows you to pay your debt over time. For smaller debts, a streamlined agreement can often be set up online in minutes, preventing further collection actions like liens or levies. These plans typically extend up to 72 months, breaking down a daunting balance into manageable monthly payments. However, it's crucial to stay current. Defaulting on the plan can reactivate aggressive collection efforts. For those in severe financial hardship who truly cannot afford to pay their full tax debt, there is the Offer in Compromise, or OIC. An OIC allows certain taxpayers to settle their tax liability with the IRS for a lower amount than what they originally owed. It's a powerful tool, but not an easy one to obtain. The IRS will only accept an OIC if they believe it represents the most they can ever expect to collect from you within a reasonable time. The application process is extensive and requires a full, transparent disclosure of your financial situation. This isn't just a simple form, it's a deep dive into your life. The IRS will analyze your ability to pay, scrutinizing your income, your necessary living expenses, and the equity in your assets to determine your reasonable collection potential. Securing an OIC is difficult, with a stringent review process. But for those who qualify, it can provide a powerful fresh start, resolving a seemingly insurmountable debt. Other options exist for specific situations. If your financial situation is so dire that you cannot afford even basic living expenses, you may be placed in currently not collectible status. This temporarily suspends collection efforts, but interest and penalties continue to accrue, and the IRS will review your financial situation periodically. If you believe the IRS has made a mistake, you can appeal the assessment. And if penalties make up a large portion of your debt, you may qualify for penalty relief if you can show a reasonable cause for your failure to pay or file on time, such as a serious illness or natural disaster. In cases of joint tax returns, an innocent spouse may be relieved of the tax debt caused by their partner. Finally, filing for bankruptcy can temporarily halt IRS collection actions due to the automatic stay, and some older tax debts may even be dischargeable. Each of these paths has specific rules and requires careful consideration. Fear about the IRS is often fueled by misinformation. Many myths circulate painting the agency as an unstoppable force that can ruin your life without warning. Debunking myths with facts is essential. One common myth: the IRS can show up and take your house without notice. This is completely false. The IRS must follow a long, legally mandated process, sending multiple written notices, including a final notice of intent to levy. No seizure happens before those steps. You will have many warnings. Reality: seizure of a primary residence is exceedingly rare. Law and IRS guidelines create high barriers and usually require a court order. The IRS is a bureaucracy, but it exists to collect money. Representatives are trained to set up payment plans and guide taxpayers toward resolution. Ignoring their letters guarantees escalation. Call the number on the notice. State your intent to resolve the debt. That's the single best action you can take. It shows cooperation and opens the door to solutions like an installment agreement. An installment agreement can immediately stop progression toward a levy. Final dangerous myth: hiding your assets or ignoring the problem. This is the worst strategy. The IRS has powerful tools to find assets and income. The statute of limitations to collect tax debt is typically 10 years. Ignoring the problem only leads to more penalties and interest and eliminates your chances to negotiate a favorable settlement. The debt will not disappear. To see how these rules work in the real world and to understand the profound impact of your choices, let's look at some common scenarios. These examples are simplified, of course, and every taxpayer's situation is unique, but they clearly show how different choices can lead to vastly different outcomes when dealing with the IRS. First, consider Alice, a freelance graphic designer. Like many self-employed individuals, she manages her own tax obligations. After a few unexpectedly lean months, she fell behind on her estimated taxes and now owes the IRS $15,000. Soon, she receives her first official notice, a CP-14 bill, which is the IRS's formal demand for payment. Panicked, her mind races with worst-case scenarios. She imagines the IRS seizing her client payments or putting a lien on her home. She considers ignoring it, hoping it will just go away. But instead of hiding, she takes a deep breath and calls the number on the form. The IRS representative on the line is professional and explains her options clearly. She doesn't have the cash to pay in full, so she applies for an online installment agreement, a common solution for taxpayers in her position. Because her debt is under the threshold for a streamlined agreement, Alice's application is quickly approved. She agrees to pay the IRS $250 a month for 60 months. While interest and penalties will continue to accrue, the amount is manageable for her budget. As long as she makes her monthly payments on time and stays current on her future taxes, the IRS will take no further collection action. This means they will not place a lien on her home, which could damage her credit and ability to sell the property. And they certainly will not levy her bank account, which would have frozen her funds and disrupted her business. Alice successfully prevented the problem from escalating by taking one simple, proactive step. She made a phone call. Her situation is still stressful, but now it is structured and manageable. She protected her home and her livelihood by choosing to cooperate instead of hide. Now, let's consider Bob's much more serious situation. He owes $85,000 in back taxes, penalties, and interest from a failed business venture several years ago. Overwhelmed by the debt, he ignored years of notices, hoping the problem would somehow resolve itself. It didn't. The IRS has already filed a federal tax lien, a public claim against all his property, including his home. And now, he just received a final notice of intent to levy by certified mail. This is the IRS's last warning. The 30-day clock is ticking before the IRS can legally seize his assets. Bob finally understands he is in serious trouble and cannot handle this alone. The stakes are too high. He hires an enrolled agent, a federally licensed tax professional who is authorized to represent taxpayers before the IRS. The agent immediately contacts the IRS and files a timely request for a collection due process hearing, which stops the levy while they negotiate a resolution. The agent determines that Bob may be a candidate for an offer in compromise and helps him compile his financial records. The OIC process is grueling and requires full financial transparency. Bob has to document all his income, assets, and allowable living expenses to prove he cannot pay the full amount. After several months of intense review and negotiation by his agent, the IRS determines that Bob's reasonable collection potential is only $22,000. They accept his offer. Bob borrows money from a family member to pay the settlement amount in a lump sum, and upon payment, the IRS releases the $85,000 tax lien on his home. By seeking professional help, even at the last minute, Bob settled his massive debt for a fraction of the original amount, saving his home from a potential seizure and sale. His decision to hire an expert was absolutely critical to navigating this complex process and achieving a positive outcome. The threat of losing your home to the IRS is frightening, but you can meet it with decisive action. The power isn't entirely in the government's hands. You have rights and clear options. IRS can place a lien on your home, which is a public claim on your property. It can escalate to a levy and, in rare cases, a seizure and sale. This only happens after many notices and missed chances to resolve the debt. Act early. Never ignore their communications. First step: open and read every piece of mail from the IRS. Don't toss it in a pile. Deadlines on those notices are real. If you don't understand a notice, call the number on the letter. Have your social security number and a copy of the notice ready. That initial contact is your first line of defense. Next, assess your options. Can you pay in full? If not, visit irs.gov to explore an installment agreement or see if you pre-qualify for an offer in compromise. If you get a final notice of intent to levy, act within 30 days to request a collection due process hearing and pause the levy. Gather financial documents now. Pay stubs, bank statements, monthly bills. Don't be afraid to ask for help. If it's large or complex, contact a qualified tax professional. A credentialed tax attorney, a certified public accountant, an enrolled agent. Low-income taxpayers may get free help from a low-income taxpayer clinic. Act calm, informed, and immediately protect your home. Beat.